Hello, this is Dean Kernut, and welcome to the Alpha Exchange, where we explore topics in financial markets associated with managing risk, generating return, and the deployment of capital in the alternative investment industry. Now the Chief Market Strategist at StoneX, Kathryn Rooney Vera comes from humble beginnings. As a teenager, she cleaned houses in order to contribute to her family's finances. In college, she changed her major to finance from liberal arts, seeing a more direct path to a well-compensated career. She would ultimately settle into the study of economics, a craft she continues to refine today in support of clients and colleagues at StoneX. Our discussion surveys the process Kathryn uses to find value in markets. She focuses on forecasting growth and inflation, the Fed's response to these variables, and the construction of trades that will capitalize on them. We review some of the recent cross-asset volatility and the role that positioning played. Kathryn rightly suggested that clients utilize protective option strategies in the period prior to August 5th. She's also seen value in curve steepeners, embedding a little bit of the SOM rule notion that the Fed may find itself behind the curve. Lastly, she sees a favorable setup in the utilities sector, providing both the traditional defensive property through its linkage to rates, as well as embedding an AI play that can empower it should the boom continue. I hope you enjoy this episode of the Alpha Exchange, my conversation with Kathryn Rooney Vera. My guest today on the Alpha Exchange is Kathryn Rooney Vera. She is the Chief Market Strategist at StoneX. Kathryn, it's great to have you on the podcast today.
Thank you so much, Dean. It's a pleasure to join you today.
Well, you and I have only just recently met, and you were kind enough to join my Macro Minds conference. And so we got a chance to chat a little bit there. And I started following some of your work. And I thought, wow, this would be a great conversation to have, get some of your perspectives on the recent vol in the markets. You have a very cross-asset framework for looking at these things. And this has definitely been a very cross-asset risk event. So it'd be an interesting backdrop against which we can have our conversation. Let's first learn a little bit more about you, about your role at StoneX as Chief Market Strategist. Tell us about how you found your way into this wonderful world of high finance.
Yeah, awesome. Happy to start there. So I started at StoneX here 1 year ago as the Chief Market Strategist. I report into the holding company and support the various lines of business. Principally, there are three. There's commercial, which is generally commodities. There's the retail area, and then there's the securities division, which is where I primarily focus my energies. And here, what I do is I publish a global macro cross-asset strategy notes. As an economist by background, I like to consider myself more of a market economist. So I talk to institutional clients primarily, giving them my economic forecasts for the US and the globe with investment and practical investment strategy recommendations therein. But just starting out, I come from New Jersey. I consider myself a self-made woman. I come from a middle class, working class background in New Jersey. I started college targeting a liberal arts degree or something fun like that, political science or communications, thinking I'd be, a syndicated columnist or maybe a senator. And then 9/11 happened. And my father was a pilot out of Newark Airport. And in those scary, very scary times, those times were wrought with financial and emotional tumult and turmoil. And I was the oldest of six kids. I changed my major to finance to make money for the family. Back in those times, IB, investment banking, all of that was where it was at. So everybody wanted to make the big bucks on Wall Street. And so that was very formative for me. And in previous financial turmoil for the family, I can proudly say that I helped my mother as a house cleaner. I cleaned houses to help make ends meet for our family. So talk about life lessons, right? I think that was formative and that was impactful. And I'm so thankful for all those experiences because they made me strong, resilient, persevering, and I like to call myself scrappy. So that was kind of my upbringing. But finance wasn't for me. I found my true passion in economics and thinking strategically. I double majored in Spanish, lived in Spain, and now I'm fluent in Spanish. And today I give keynote addresses in Spanish and regularly speak to Latin American clients in their native tongue and appear on Spanish-speaking television. So that's a little bit of my background. And then I started out at MetLife Investments right out of college. I was in asset-backed securities, but I quickly found the right spot for me in emerging markets research and spent 15 years in emerging markets. I hunted down the best opportunities for me to enter sell side, which is, I guess you could say, where my assets are most complementary or my skill set. I found myself identifying with Bear Stearns just a couple years before the collapse. It's a hardworking blue collar culture of guys and gals with their serious smarts and work ethic, could make good money and great careers for themselves. And I identified with that. So Bear Stearns was awesome, but it was formative for sure. I lived to see the $2 bill slapped on the door after Bear went under, the only place that was hiring. I felt like I went to the dark side. I went to the Fed as a bank oversight analyst and jumped from there. I didn't last long there. It really wasn't for me. Jumped from there to recreate the Bear Stearns fixed income research platform at a boutique investment bank based here in Miami. And I've been here for 15 years. That's a bit of my background.
Fantastic. So many interesting things there. And I'm particularly drawn to your humble beginnings. And it's just great to hear a story like this where you've become something just so much different than you started. And I think it's a real testament to grit, as they say. And I think the speaking Spanish, especially delivering keynote speeches in Spanish, boy, that's really interesting. And you access, I mean, just commercially, you're accessing an entirely new investor base, really, by virtue of your capacity to speak a different language. So very, very cool. You mentioned economics, you mentioned finance, and this idea of being a Wall Street economist is very different than being an academically trained economist or someone who lives and breathes in models and so forth. Tell us just a little bit about, from your perspective, the role of covering clients, institutional clients, being a source of answers and insights, I'm sure, for colleagues who are using your work in accessing clients. Just talk to us a little bit about the day-to-day in terms of your role at StoneX.
Well, global macro is generally rates and FX, but in my purview, it's much more than that. So I rely heavily on models. So I built them over my career and in my team as well. We take big data and we synthesize. And I think the most critical part and how someone in my role can be successful, Dean, is by taking a lot of complex ideas and numbers and synthesizing them and coming up with a concise output that you can communicate effectively to the client. So taking a lot of data across global economies and across asset classes and saying, this is where I think you can make money. And this is why. So there's a lot in the background in terms of the grunt work that you don't see behind the scenes, especially for people like me who are much more front office, client facing and media friendly. I can commiserate with other chief market strategists, chief investment strategists who go on TV and do a lot of high profile speaking engagements because I get you. It's really not that easy to take these complex ideas and make them into bite-sized talking points. And I think that's one of the most important roles is communicating these ideas in a very understandable way. And so in my role at StoneX, who do I talk to? Mainly, you nailed it on the head. I have two worlds. I have the Latin American world and I have the English speaking world. Both of those are fun and it keeps it interesting, to be honest with you. So I travel quite a bit to Latin America and I meet with all of the pension funds and life insurance companies, as well as hedge funds that are big players in that world. That's Central and South America. And then add to that in StoneX, we have a very large US presence, very large European presence. And so the travel to Latin America has widened out to travel to Tokyo and Singapore and London and Frankfurt. So it's been a really good ride. And all of those clients really want to know, in a nutshell, where are things now? We get that. But where do you see them going? And how can I make money off of that? And that's where I consider myself the market economist. So, for example, coming into this year, the markets were anticipating the first cut in March. So if you disagree with that based on economic analysis, then you play the Fed funds futures market. That would be a way to play that economic forecast. And that's the name of the game. So I take an economic view, I forecast out inflation numbers and aggregate demand and their subcomponents, determine what the Fed is more or less likely to do, and try to find the best ways to execute in the markets, whether it be in fixed income, equities, or FX, how to best express that view.
Well, I had a chance to read some of your recent work. And so you had some research on Japanese yen, and you looked at the yen, I think, from a purchasing power parity lens, through that lens, the PPP lens. And what I see coming out of your work is a different PPP. I would say it's price, positioning, and protection.
Mm-hmm. I love that.
So those are three Ps that I see prominently in your work. And so as you mentioned, fading this idea that the Fed was set to cut so earlier in the year, that's really all about price. You're looking at futures curves, the yield curve, and looking at what's actionable. I've seen some of your recommendations on SOFR option trades and on protection in the triple Q. Let's run through your framework a little bit, maybe with some of this in mind, with positioning in mind. I know that really comes up as part of your work on dissecting the tumult of last week in yen that kind of flared out around the world. Walk us a little bit through just your framework. So obviously you're doing research on the economy and forecasting, but there's an overlay of market prices that figures prominently in your recommendations. Talk to us a little bit more about that.
Oh, absolutely. Well, positioning is really of the utmost importance when you're determining where institutional investors could find value in the market. So, for example, when you look at how extreme the levels were in terms of using the yen as a funding currency and leveraging that low zero yielding currency to fund higher yielding bets across the asset classes, the enormity of that positioning was so stark that that is a major reason, one of the major reasons that we saw the recent, although temporary, market meltdown. So we do look at investor positioning. It's very important. And then when you look at long dollar positioning, that's also incredibly relevant. So you have very short yen, and generally you continue to see real money accounts massively overweight dollar and dollar denominated assets. So positioning is absolutely critical when we're looking at these types of trades. And what I spoke about in the piece you're referencing, which is the Bank of Japan resetting inflation rate expectations, you can do a PPP analysis of the yen and you can determine that it's still enormously undervalued. And when you look at the dollar, you can do a similar exercise to see that it's overvalued. So I think that there are opportunities and risks to this type of analysis, Dean, the structural kind, because just to give you an example, I was having this debate here internally, which is what happens to the dollar after the election, or what happens to the dollar when the Fed starts cutting? You might think, oh, the dollar's going to weaken, but not really, not really when you have these large, even though they're getting smaller, these disparities in interest rates between the dollar and the yen, or the dollar and really anybody else. So yeah, the yen funded carry trades I think is really important. So what am I looking at now? We saw a lot of short covering on the yen, and CFTC data shows that net speculative positioning in the yen has largely been covered. Now what we're seeing is a reaccumulation of this trend, and that's something that I think could warrant additional caution on the horizon. If we get a resumption of this risk on trade funded by the yen, and I think part of the problem here is that the BOJ kind of ceded to the market meltdown and market skeptics, basically saying we're not going to be hiking rates anytime soon. So what does that mean? When you have a market that's almost completely recovered all of its meltdown, it means more risk on. So these are things that on my team, we certainly look at. We look at purchasing power parity, which is generally a structural issue, but then near-term positioning and risk appetite. And from my perspective, Dean, I know you've been reading some of my stuff. I think there are inherent risks that are underpriced in the market. And so from my perspective, I think it makes sense to protect your gains in general. Doesn't mean liquidate positions that are heavy on risk, but it certainly means to take advantage of opportunities where you see euphoria or complacency or even greed to put on counter-cyclical portfolio policy, which is how I call it.
One thing I think is interesting is you point to that large, long position in the dollar. For a long period of time, I would say really the last 2 years, it's really been a function of the Fed's tightening cycle. You've seen a pretty consistent, very positive correlation between the dollar and the VIX. And we remember, let's call it late 2022, where we kind of got close to a breaking point there, where the dollar just rallied so ferociously. It had a lot of folks off sides. I think the VIX got into the 30s. And I believe we were saved by a more benign CPI print. I think Lael Brainerd may have emerged as a dovish voice within the Fed and basically saying, let's slow this thing down here. But you typically had dollar stronger, VIX up. And so what happened last week is that wholesale reversal of that correlation, at least against the yen. The dollar sold off and the VIX absolutely spiked. And I think it sort of speaks to this idea that people in markets really just price what they experience recently. When a correlation is in place, the trades built around it become vulnerable to a break of that correlation. You mentioned just on the motivation for this risk event. Let's just say it starts really with some weak economic data in the US and then paired with the opposite in Japan, maybe at least on the inflation side and some hawkish commentary. But then you had the deputy governor, as you said in your note, stood down and said, hey, look, we're not going to do this if market conditions are too volatile. Do you think that sort of keeps the market at bay for a period of time? Are we at risk of this thing flaring up again should Japan get an inflation print that's unwelcome? Like, where do you see this going from here?
It's a little bit of a moral hazard risk because you're basically reigniting the fire in a sense. And short-term traders are going to say, oh, fantastic, even though wages are surging in Japan, even though the economy is doing very well, tourism is near record highs, and inflation expectations and inflation metrics warrant higher rates. BOJ is committed to not doing that, explicitly committed to not doing it for the rest of the year. So what have we seen happen? We've already seen this new using the yen as a funding currency trade come back into vogue. So I think, yes, I think it does open us up to some more downside for guys and gals that have positioned themselves or continue to lever up. So definitely, like I wrote in my piece, Dean, I think there are inevitable bouts of volatility, particularly as this yen carry trade fully unwound and now winds back up again.
Right. And what's so interesting, and you had a very timely call on using puts in the triple Q, I think was at least one of the recommendation. Obviously, it hit quickly. But what do we know about these markets is you've really got to monetize your exposures. Those gains can fade very rapidly. So you had this really outsized pop in the VIX. It's come back much more than I personally was expecting it to. I knew it was set to reverse, but boy, that's a substantial, I think it's the fastest ever, call it 10-day reversal in the history of the VIX. I'm almost positive that that's the case. And so it sort of resets, in some ways, the price of insurance from an entry point standpoint. How do you think about protection on behalf of your clients in the current state of pricing in the options market?
I think it opens up opportunities to protect those positions. So this is a cautionary tale that I've been advising our clients tactically to put on. And as you mentioned, we did recommend protective options on tech back on July 26th. Those were 30-day NASDAQ sector options, 95%, 85% moneyness rolled. We closed this recommendation. Actually, we closed it on August 5th with, more than 300% return for those who would have executed it. So I think that when you get a backward slide again in the VIX, as you highlighted correctly, then it opens up additional opportunities because, of course, when the fear index plummets, then these options for equity analysts or equity portfolio managers, rather, that have tech positions, which tend to be vulnerable, especially given valuations and especially given underpriced risks on the economy and the potential for some possible policy error on the Fed, neither of which are really discounted in the markets at this point, makes them attractive, in my opinion. So I think some froth came off the markets, but I think there's probably more to come. I think 2 weeks ago, Friday, non-farm payrolls report was confirmation that the markets are going to be highly attuned, leveraged, and very sensitive to high frequency economic data. And I've heard it called the everything is awesome trade. But the days, in my view, are numbered. And I think the perfect landing scenario that's baked into the markets has really underpriced the real risks of the outlook. I think that they're bipolar in nature, truly bipolar. I mean, when you think about it, we're in a scenario where, in my opinion, recession risk is at least double what it normally is at any point in the economic cycle, which is about 20%. So I think it's about 40% over the next 12 to 18 months. And then on the flip side, you have the reality, which is that the US economy is growing at about 2.8%, which is nearly 1 full percentage point, Dean, above potential growth, which itself is inherently, when you think about it, inflationary. So on the one hand, you have that fat tail risk of the possibility that corporations start to make big layoffs because they need to shore up their bottom line and cut costs. And the quickest way to do that is by cutting the fat and unloading the job hoarding phenomenon that occurred over COVID, and that would lead to recession. And then on the other hand, you have the reality, which is the economy is doing pretty darn good right now. And there could be recency bias as you had alluded to before. But the truth is the economy is growing very strong. So let's say were pro-growth policies to be implemented in a potential next administration. That sounds fantastic. But at the same time, you want counter-cyclical fiscal policy rather than pro-cyclical. So if we juice the economy even more, we could get a reacceleration of inflation. To me, those are the two fat tail risks. And I think there's ways to do that. And I think it's not just the put recommendation on the NASDAQ and the S&P. You can do it for at 1 month, you can do it at 12 months, whatever your horizon is, doesn't matter. But there's other options as well. You can buy defensive, such as utilities, which has been one of my top performing recommendations year to date. It's defensive, but it's also a second derivative to the AI trade. So it could work under both fat tail risks. That's why I love this sector. It makes sense to me. It's inherently defensive, so it should do well in downturns. But if you think the everything is awesome trade is going to continue and has legs, then you might want to look at the tailwind, the sectors that have not outperformed to that extent, which can benefit from, if you're a believer in this, the ongoing froth in the AI trade. Those two things I think are utilities and industrial real estate. So I think that's a way to be defensive. And then finally, I would say the belly of the US Treasury curve, 2 to 5 years, makes sense to me, as does cash. I mean, cash is still yielding more than 5%. And I think that once the Fed starts cutting rates, all the $6 trillion that are sitting in money market funds, team, those are going to move into, some of it will move into equity, sure. But is equities really a complementary asset class to cash? No. What is a complementary asset class that also benefits from a drop in Fed funds? It's the short end of the Treasury curve. So 2 to 5 year paper, I think, makes sense. That's also a trade that's done very well. And I also like steepeners from a more structural perspective.
Yeah, I mean, it's not hard to think about the option value of cash up here at 5+%, especially when equity market vol gets higher. The utilities is interesting. I'd wanted to explore it a little bit more with you. And we're all looking for more than one way to win in an exposure. Utilities have developed some beta to the AI theme. I was looking at the XLU, its performance last Monday, August 5th, and it wasn't great. It was down 2.8%, I want to say. And that was a day, obviously, that the bond market rallied a fair amount. And so that was interesting to me. It told me that the AI concept won or lost for the XLU that day. But just be curious to learn a little bit more about how you think about the first and second derivatives, the drivers of the XLU today versus how we know that sector to traditionally relate to things like interest rates.
Well, yeah, so far it's had a good run. Utilities is the third best performing sector in the S&P year to date. The AI trade is obviously largely best reflected in first order beneficiaries. Everyone knows about this trade. I think it's generally priced in, more than priced in, for the promising future for AI in the economy and society. All of that is true. But in my opinion, really AI has to deliver now. And I'm not convinced that corporations that talk as much as they do on their earnings calls about AI as the zeitgeist buzzword, I don't think that they have deployed it to the extent that they've talked about it. So I'm a little suspicious of those who say that this improvement in productivity that we've seen is already due to AI. Of course, some of it is, but I do think that AI does have to deliver on the productivity front. And that, I have to say, as a little corollary, will have repercussions for the labor market. So maybe it's already occurring, but it's really impossible to define as of yet. So what am I saying? I'm saying that if AI truly has been deployed, and I don't think it's been deployed to its maximum extent, part of the rollover that we've seen in unemployment could be from this tenacious investment in labor-saving technology that AI has afforded companies. And I think that makes sense. So just going back to the AI idea. So AI relies heavily, of course, on energy. And so when I think about who could potentially benefit from a positive scenario where AI and tech leaders continue to lead the market, I think the sectors, the bond proxy of utilities and its low qualities and its lower valuation just makes sense. You have AI-driven generative large language models like ChatGPT. That requires massive computational power, orders of magnitude more than a normal Google search. And you need space. You need data center construction and expansion. You have that happening from tech giants, Microsoft, Amazon, Google, Meta. So I think that you have that form. They're extremely power hungry. If you think that this is an area that's going to continue to drive the S&P, which, by the way, a third of it is already attached to tech, then I think it makes sense to look at utilities. Although, really, I'm looking at RSI right now, and it looks a little overbought at the moment. But utilities may perform well, as I mentioned, under the opposite tail risk scenario, which in a strong growth or a no growth scenario, risk assets rise, utilities could benefit from the second order effects of AI, but they historically perform better in a hard landing scenario because it's a defensive sector and it acts as a bond proxy. And that often outperforms during recessions and bear markets.
And so there is more and more attention, I think, on the real economy. We clearly spent most of 2022 and into 2023 focused on inflation dynamics. Inflation got higher. Whenever that happens, it becomes more volatile. I focus a lot on things like the VIX. There's the one-day VIX. The day before the CPI, the one-day VIX could be as high as 40. I mean, just gigantic risk premiums in 2022 ahead of this CPI day releases because it was so uncertain and the Fed's policy response was very much in flux. That's really not a thing anymore, not nearly to the extent. But what has picked up is the beta of the market to growth shortfalls, whether it's a soft NFP, that sort of thing. And so it's a different environment. When you step back and you look at the big picture of the growth and inflation dynamics in the US, there's a lot of focus on the SOM rule as an example. It's a little bit retrofitted to find something that works, but I kind of like it because it makes a statement that I agree with, which is once something increases, it's not likely to just stop, right? I mean, that doesn't happen with vol. It doesn't happen with inflation. It basically says the Fed's got a very tough job. And so when you look at the robustness of the US economy, are you more concerned that we could be experiencing a shortfall? You were commenting that things look pretty good. How do you look at the next 6 to 12 months in terms of the US economy?
I think the path ahead is complicated for the US economy, especially as you mentioned, Dean, and Claudia Sahm is a fabulous economist. And the person who created the SOM rule, of course, has depicted this very well. When you look over history, the unemployment rate historically jumps or drops. It doesn't gently tick up like the summary of economic projections from the Fed shows. That's not a historical reality. So I think the risk that I view is in the labor market. I think the labor market dynamics would ultimately affect an economy based on consumption. So it comes down to how does the labor market fare? Do companies start to unwind the job hoarding phenomenon that occurred over COVID? Because we really haven't seen that yet, to be able to cut costs in the face of a decelerating US consumer. I think they do. So I think that risk is there. I think the SOM rule is useful, but Claudia Sahm is a friend of mine and lovely, and we've talked about it. And what she's been clear is on saying is that it's not an economic rule. This is a tool that we use over time. And yes, it does have a very high accuracy hit ratio, but it has misguided in the past. For example, in early, I think it was 1960s, it triggered and the US economy didn't enter recession, but it did 6 months later. So we can't be complacent. The SOM rule triggered. There are dynamics at play here. There are certainly increased firings, but as we all know, there are massive new entrants to the labor force, and this comes from immigration. So there's a lot of people out there looking for jobs, and that pushes up the unemployment rate. So this time could be different. I generally despise that phrase. I think this time is almost never different. I think that COVID and the massive fiscal stimulus and the massive monetary stimulus that resulted from it, I think probably kicked the can down the road. But the truth is, one of my strongest convictions is that the economic cycle is intact. There is an economic cycle, it's intact. And I think that the recession has been delayed and we haven't just jumped into some new alternate plane of economic reality. What I'm getting at here is I think that recession is part of the cycle. Impossible to predict when it will occur, but I think it makes sense to investors to consider that as they're positioning going into 2025.
If we think about Fed policy cycles, whether they're easing or tightening cycles, you can have them go one of two ways, and each has different implications for, let's say, the VIX of interest rates. We'll use the MOVE index. The Fed's tightening fast in 2022, and the MOVE is going up, and it's going up quite a bit. If the Fed's tightening in 2017 the move was as quiet as could be. They're slowly taking things back after a long period of very low rates. And they're really just adjusting. They're not chasing inflation. In fact, inflation's quite low and very stable back then. In 2022, it's obviously they're fighting it. And the opposite's also the case. And this is what I wanted you to reflect on. The Fed's going to start easing. We know that that's coming. We don't exactly know the magnitude of it. But the open question is, are they easing because they've got this permission structure that's on hand from the inflation achievement, call it 2.9%-ish, looks reasonable, and they're starting from a very high funds rate. So that's easing because you can. And then the other scenario is you're easing a little faster because you kind of have to. Growth is deteriorating. And that's probably associated with a different vol regime. I'd love to just hear you talk out loud about how you think about those quadrants, so to speak.
To the extent the Fed can cut rates based on price stability, the inflation side of their mandate, as opposed to the maximum employment side of their mandate, that determines where we are in the economic cycles as a soft landing or a hard landing. If the Fed is able to launch a loosening cycle because inflation is giving them the opportunity, not because the unemployment rate is jumping, then that's great. I think that's where we're still as yet unclear and no one can really know. I think if you look 43% of the time, 3 out of the past 7 instances, this is something that in my team we looked at, recession occurs within the following 12 months after the first Fed cut. So 3 out of the past 7 instances, we've seen that occur. So it's not an insignificant risk. And really, when we see recession is when the Fed starts cutting. The question, of course, is you can only answer this later. Did the Fed cut for which part of their mandate, for the inflation or the employment part of the mandate? If the economy doesn't enter recession over the ensuing 12-month period, the S&P averages nearly 20% up over that time. If the economy does enter recession over the ensuing 12-month period, the S&P averages minus 10% over that time. And that's 12-month periods. I mean, we can look peak to trough drawdowns in those 3 recessions where we had bear markets. They were between 39% and 57% negative. So things can get ugly quick. And I think that's one of the messages that I'm advising our clients just to consider that when we talk about those quadrants, we have the inflation quadrant, we have the Goldilocks quadrant, we have the disinflation quadrant, we have the stagflation quadrant. Everybody alive today in the financial markets, working in the financial markets, we've lived the vast majority of our lives in the Goldilocks environment, low inflation, high growth. So our behavioral economics piece of it reverts us to believe that that is our base, when in fact, these things really are cyclical. And so what happens if we go into some sort of stagflation or recessionary environment, fixed income outperforms and large cap underperforms? So I think that's just something to keep in mind. And with regard to the Fed, I think it's very unlikely that the Fed is able to hit their 2% target and their long run neutral rate in the current environment of above trend growth. So more likely than not, they start cutting in September. I'll bet they go 50. I bet they do 2 50 basis point cuts. That would be my guess. And I think next year they may do 100 for a total of 150. So that doesn't get them to where the Fed sees their long run neutral rate at. I think it's probably going to be higher.
I have in my notes for our discussion to talk to you a little bit about the fiscal side and all of this discussion around the Fed tightening so much and the US economy holding up so well. It's sort of, to me, at least potentially some elephant in the room is, well, yeah, you're running a 7% deficit with a sub 4% unemployment rate. It's going to be a little hard for those rate hikes to really bite. I mean, they're going to undo some of it. You also have the circumstance where, I think on the housing front, everybody's got this super attractive mortgage rate. So I feel like businesses and consumers are just not as exposed to higher rates as they were perhaps in 2006, as an example. How does the fiscal side make its way into how you think about growth dynamics, inflation dynamics, and the Fed's mission?
It's interesting that you mentioned the mortgage market. It's so true. And that's how I think about the credit cycle. Usually at this point, after 550 basis points of hikes by the Fed, we would have some form of credit cycle, meaning you would have some default in the most risky assets, leveraged loans, high yield, emerging markets. We haven't seen it. Same thing with the mortgage market. And why is that? It's because the Fed kept rates for so low for such a long, extended period of time that smart guys and gals, what they did was refi. So the effective rate is so low, it makes very little reason to sell your house when you can't buy an comparable equivalent because prices have surged and you would lock in a rate that's 2 to 3 times what you currently have. So same thing with the high yield. So what corporates did was they pushed out the maturity wall. So we haven't seen that credit crunch. Doesn't mean it won't happen. It just means it hasn't happened because there was that refinancing component. But I love the fiscal part of the conversation. I think it's so important to talk about it because I think it doesn't get enough airtime. When I look at interest expenditure of our country versus GDP, it is just skyrocketed. I mean, it's just a very little acknowledged visual, but I have it myself. And back in 2022, interest payments as a percentage of GDP in the United States were a little under 2.4%. And that has jumped to 3.8% in about a year and a half. Of course, we have to issue debt to cover our massive deficits. We've never seen anything like running this level of deficits in an economy that has completely covered its output gap. So we're in a positive output gap now. And at the same time, and this is a point that I really like to make, and thank you for giving me the opportunity to do so, is that China is holding fewer US treasuries inelastic to price. So you have price sensitive buyers gaining proportional importance in terms of treasury holdings at the expense of price insensitive or price inelastic buyers. Price inelastic buyers are central banks. They're the Fed, it's China, it's Russia, it's Saudi Arabia. These are entities that are buying fewer treasuries at a time when we're issuing more of them. And we need to issue more because we have enormous fiscal deficits. And so this to me just says structurally term premium are just going to go much higher. And it leaves US treasuries to be increasingly absorbed by price sensitive buyers, which are you and me. We care about the price. Fed doesn't care about the price. China, Russia, Saudi Arabia, they don't care about the price. So since the US put sanctions on Russia, what happened? China said, hold up, if I'm not in the friend zone, I'm vulnerable here. So what did they do? They started buying gold. And that's why gold went up. It's not because retail guys and gals were holding gold. It's because the central banks were holding gold. So when I look at those numbers, it causes me concern. And I have to tell you, I do also like gold as a defensive. I think it makes sense. I think people are going to start looking at it increasingly so. But when you look at Federal Reserve and foreign central banks together, they owned a combined 70% of US treasuries in 2015. Now combined, today, they own less than 50%. So treasury issuance is, as I mentioned, Dean, increasingly falling on price sensitive domestic private sector.
There was a Bloomberg article months ago about essentially 3 or 4 people at 3 or 4 giant hedge funds being responsible for a incredibly sizable amount of the bid to treasuries at auctions, essentially setting up the cheapest to deliver basis trade. That's the buyer base. They're buying it against another asset. They're not buying it because they see value or a business plan in rectifying what you rightly identify as pretty scary interest rate dynamics. It's just shocking to me. The CBO forecasts this stuff out, and even without superimposing the inevitable, which is a recession and tax receipts falling, the numbers, even without that, look absolutely frightening. And so I think when you talk about term premium, and I think some of your work on curve steepeners as a defensive asset, also, I think that resonates quite a bit with me. So interesting, such an interesting time. And I think, Kathryn, just to be able to have this cross-asset framework and bring it all together, I think's a real value. I really enjoyed this conversation. I'm very glad we had a chance to connect and learn a little bit more about how you think about the world, the work you're doing at StoneX on behalf of your clients. So, Kathryn, thanks so much for taking the time.
Dean, my absolute pleasure. Thank you so much.
You've been listening to the Alpha Exchange. If you've enjoyed the show, please do tell a friend. And before we leave, I wanted to invite you to drop us some feedback, as we aim to utilize these conversations to contribute to the investment community's understanding of risk. Your input is valuable and provides direction on where we should focus. Please email us at feedback@alphaexchangepodcast.com. Thanks again, and catch you next time.